Okay, what is up, traders? What's up, tycoons? Super excited for today's video. We're actually going to take a look at LABU, which is the biotech bullish leveraged ETF. It's the 3X ETF. And so the first thing that I want to do is actually start off with LABU versus the Fed funds rate. Okay, so the Fed funds rate is going to be here in orange, and LABU itself is going to be in red on this chart. And the reason I'm showing this to you guys is because interest rates and the Fed fund rate is a very big topic in the year 2023. A lot of people are debating, are we going to see rate cuts? Are we going to see a pause and pivot? So I want to go over the history of the chart of LabVIEW and show you guys how it's performed in accordance with the Fed funds rate. And then I'll show you guys some other things as well as break down LabVIEW, give you guys some really good technical analysis. And also we're going to take a look at XBI, which is just the regular biotech sector ETF. There's some really good and interesting stuff that you can learn by looking at these things. So make sure to smash that like button, subscribe to the channel if you guys are new, and we're going to jump straight into it. And we can see that in this period here, when the Fed funds rate is rising and accelerating, okay, going up, we see that LabVIEW is in a descending period, right? And typically, the reason being is because biotech companies, a lot of times they take on a lot of debt, okay? And so they're taking on a lot of debt and taking loans out so that way that they could fund their research and hopefully come up with some groundbreaking technology or patent or some type of new whatever it is, like a vaccine or something like that. And then they'll see all the profits once they establish that and once they get that breakthrough. So a lot of times they're taking in a lot of debt and they're taking out loans and they're getting a lot of funding. In high interest rate environments, it makes it more expensive for that to happen, right? It's going to cost more to get those loans and to get funding from other investors. Now, over here, we have an interesting period where we're actually seeing rising rates in 2017 and 2018, and we're also seeing LabVIEW continue to go up as well. So, it doesn't always have to mean just because rates are rising that LabVIEW has to go down. But I was just trying to, and kind of explain some of the general thesis and why you may see LabVIEW underperform in periods where interest rates are going up or they're very elevated. Now, if we look at here, this is 2020, and this is a low rate environment. All right. This is, the Fed funds rate here in 2020 cut down to nothing pretty much. And we can see that LabVIEW exploded, right? Went up 323% in this time period. And this is a very risk on type of environment because now people can get the funding, all right? Investors can go take out a loan and fund these biotech companies, or the biotech companies themselves can go out and take loans with extremely low interest rates. So it's a healthy environment for things like biotech. And we see that, it bottomed just before the Fed rate went all the way down, and then it accelerated very nicely, 300% in this time period. Now, this is the current chart, all right, from 2020 up to the present. And so you can see that time period here where the rates, were cut down to zero and then it was flat. And you see that accelerated, had that 300% move to the upside. But a lot of that money started coming out, and a lot of that money started flowing out of the biotech sector. And you can see that ever since the Fed fund rate has actually started increasing here, it's been very down / flat, right? It went down. It did bottom over here in about the summer of 2022. We haven't, hit those bottoms yet. But it's been very flat. It's been choppy and had some moves to the upside, but we haven't really seen a big move, regaining some of the losses that it's had. And potentially, if the Fed fund rate starts to flatten out or starts to lower, there is a possible chance that we could see this thing rise. Now, keep in mind, this is a viewer request, and I do these viewer requests every week. So if you want to see your stock, whatever it is, sector, biotech, energy, something like that in the next video, all you got to do is comment down below. And this video is not financial advice, okay? I'm not telling anyone to buy or to sell LabVIEW, rather just going over some of the pure data, the raw data, and giving you guys some really good analysis. Now, this is XBI divided by XLU is what this line is right here. And so this is a really good way to measure a risk on versus a risk off market. Biotech, all right, XBI is definitely considered one of the most risk on asset classes there is and sectors there is in the stock market. And so XLU is utilities, and this is generally a very defensive sector, right? And so what you can see is you can kind of use this to help gauge, hey, is the market going a little bit more risk on here? Is it going a little bit more risk off? So if you see XBI/XLU going up, in a general rule of thumb, the market would be more risk on. And if you see it going down, then the market would be more risk off. Now, there was this clear head and shoulders pattern right over here, but this isn't too relevant to today's data. If you take a look, we do have this uptrend here where the market was trying to go risk on since about the summer of 2022. And the market's getting a little bit more risk on, right? And we're starting to see, biotech outperform utilities when it comes to the sectors. But take a look here as of recently, since really about February, end of January, since, that time period, we can see the market's actually gone very risk off. We did have a strong pullback in a lot of stocks. And, even through the recent rallies in the stock market, the biotech sector really hasn't seen some of that, right? It's been mostly tech and mostly defensive sectors really kind of leading the way in March. There's been a lot of madness. Okay, it's definitely March Madness right now. The market went from pricing in 25 basis points all the way up to 50 to now they're pricing in 25 again. There's been bank runs. There's been bank collapses. A lot has really developed, and the market is kind of changing its mind every single week in this current environment through 2023. So, just keep that in mind, right? Like things could look good for one sector today, and then the very next week, things could look like an absolute disaster, and the market's repricing in something in right now. They don't really know truly how to price in a lot of stuff. Now, this is XBI/XLU. This is the 08 to 2014 performance. And so the stock market bottomed around the end of 2008, 2009. If you go look at SPX, and you can see that afterwards, the market basically went into a bull market, aka more of a risk on market. And you can see that this thing had an amazing performance, right? Really, really nice recovery and nice move to the upside during that time period. And this is 2020 to 21, right? We looked at LABU kind of in this time period, but this is XBI divided by XLU. And so again, what I'm trying to emphasize is, in these bull markets and in these risk on markets, you typically would see the biotech sector outperforming the utility sector. So this is something really useful just to kind of help you gauge, hey, are we, heading into more of a risk on market? Is the momentum going to continue in the biotech sector, or is this perhaps maybe a dead cat bounce? Let me take a look at the XBI/XLU chart. And if you see things like this, right, then generally, you have your bull market and you have your risk on market in these sectors. Now, this is February of 2021 through the present, and this is the risk off market, right? So it's been a brutal bear market. And we can see that, it's reflecting in the XBI/XLU pair here. And we're seeing that go down. And so when this chart goes down, it means that utilities, the second half, is outperforming XBI. Okay. Now, this is what I mentioned here in the summer of 2022. You can see we actually haven't revisited this lows on the XBI/XLU chart. And after the initial drop from, Jerome Powell's Jackson Hole speech, the market's been looking to go back risk on as soon as possible, right? We're constantly, every month, every other month, you're hearing headlines, you're hearing news saying, hey, we're pricing in rate cuts. The Fed's going to pivot. The Fed's going to pivot. Meanwhile, Jerome Powell has been saying that he's going to have higher rates for longer, but you can see, how the market feels reflected, through certain assets, through certain sectors. And we can see that really the market has gone a little bit more risk on ever since May of 2022. So I just wanted to kind of point that out before we go into the actual technicals, okay? So that way you guys have a little bit of a deeper understanding rather than just looking at some candlesticks and some technical analysis. Now, with that being said, we are going to jump into the levels. So we are trading kind of in no man's land is what I would call it right now, in between a major supply zone and a major demand zone. Okay, you can see our demand zone here. We established some demand multiple times in the past and price pushed up higher. Now, demand zone is simply where there's an imbalance of buy orders, and that imbalance creates green candlesticks and pushes the price up higher. Okay, these are all live auction markets, basically. And so you get to read, where the imbalances are coming from. Now, we previously had this demand zone here where we kept pushing up, right? Pushing up each time we came down into this demand zone. But you can see over here, we fell through this. So prior demand becomes new supply, just like old support becomes new resistance. Okay. So we can see we had this area that was prior demand many times. It's now turned into a supply zone. It's a very relevant area. So if we push up, we need to be mindful of this $6 up to about 643 region. And our demand zone here is going to be about 425, maybe 450 down to about $4. Okay. So that's our overhead supply and our underhand, our underhand demand zone. Now, if this thing wants to continue going down, right, and we want to break through our demand zone and, buyers don't step in as they have previously in the past, okay, our bearish price target right here is going to be 371. That's going to be a major support level. And if we break below there, there is a strong chance we could come all the way down to 215. Now, I know a lot of you guys are going long on this, so I will go over some of the bullish price targets and major resistance, but you need to be aware of the major levels of support and demand, because if we test those areas and we don't see buyers step in, you need to be prepared for where we could head back down lower next to. Now, we have our major resistance here. And the reason that this is our major resistance is we have the 61.8, the 50%, and the 38.2% retracement levels. These are the three most common and well-respected retracement levels using the Fibonacci tool. And you use these because nothing moves in a straight line down or in a straight line up. So we've had our swing high up here. We have a new swing low, and we're starting to try to retrace. If we were to retrace up to the top of our supply zone, that would put us at the 38.2% retracement level, right around 643. Okay, now above there, we have $7 is going to be our 50% retracement level, and 757 is going to be the 61.8% retracement level. Now, the reason that I have that these are major resistance is because when using the fibs, they're really good for establishing trend continuation or trend reversals, right? So trend continuation would be a move up, a healthy retracement, and then a continuation higher, or a move down, retracement, healthy continuation lower. Okay. So, if we, after this move down, if we retrace even all the way up to 757, we need to be aware that that's still in healthy retracement territory to possibly continue heading lower and maybe even hit some of our bearish price targets. Now, you can also spot a reversal if you break through your major retracement levels, right? So if you move up, retrace, and then you start to consolidate and break through those major retracement levels, that would be a downside reversal. And if you move down, retrace, consolidate, and break through those retracement levels, that would be signs of an upside reversal. So if we can move up, consolidate around our major resistance areas and break through them, all right, then we have the chance of putting in a double top near our breakout level here of 942. And above 942, if we're able to break out past there and not put in a double top, right, something like this, and then we head back down. Okay, if we can break out from 942, then we have some bullish price targets to the upside of 1047, 1143, and 1241. So that's really the major things that I'm watching right now when it comes to LABU. We don't have any current divergences, whether a bullish or a bearish. So I will be looking for that if something does develop there. But for right now, it's mostly just levels, price action, and we got the fibs on there, so that way we can know some of our major retracement levels of resistance, as well as the supply and demand zones that are pretty relevant. I went over the bullish and bearish price targets. Let's actually take a look at XBI now, which is just going to be the regular biotech ETF, right? Not leveraged. And you can see it looks a little bit stronger than LABU, right? So LABU came down and retested the demand zone from over here from back in May and June. Meanwhile, XBI has not retested its lows from May and June. We actually have this higher demand zone right here, which is roughly about $71, maybe 72, up to the 75 region. All right, we can see we had a strong pullback here. We consolidated a little, and then we found new demand, pushed up higher. We came back down, tested this region, pushed back up higher, and then we started creating higher lows ever since that moment. Now, we just broke down through, and we have this overhead supply zone here that's really about 78, 79 up to about I would say about 79 to about 78 is going to be our overhead supply zone. All right. And so, you can see again, this was some prior demand in this area. All right. And then once we came through, old demand becomes new supply, and the buyers weren't there anymore. And now there was an imbalance of sell orders in the area. We pushed lower. And each time we've come back up into this area, we've tested about 3 or 4 times here on the daily chart. We've ended up pushing back lower. So this is going to be a major overhead supply zone. Now, same thing as the last chart, we have our major retracement levels of resistance according to the fibs. Okay, so we move down. If we break through that overhead supply zone, 8108, 8328, and 8549 are going to be the major overhead resistance levels that we need to break through to come out and retest our breakout level of 9262. And just like LABU, we need to be cautious of a potential double top at this area, and be aware of that. But if we can break out from there, our bullish price targets are going to be 97.90 as well as 136. So that's the major levels to the upside. If we break through this overhead or this demand zone right now that we've been testing, the bearish price target is going to be right around 66.80. And you can see that's kind of lower into this area right here, right above, I would say our demand zone right over here on XBI. I would say that this is pretty much, the demand zone, and we have this bearish price target, this area of support above it that we could test and bounce off of first if we break through that demand zone. So, hopefully you enjoyed this video. Hopefully you learned something new. If you did, smash that like button, subscribe to the channel. I'm doing these requests every single week, so I'll get to yours as soon as I can. All you got to do is comment down below, and I'll try to make a video on it ASAP, okay?